So the last time homeowner affordability was this bad was back before the 2008 housing crash, where individuals with over 100% loan to values on their homes, neg-am loans, no income, no job, no asset, massively subprime loans, were buying homes many times on the speculative belief that the value would simply go up and they'd be able to refinance. And when joblessness struck and we entered into a real recession, well, that housing bubble fell apart. There are a lot of folks who believe that because home ownership affordability is just as bad as it was before 2008, we are going to set up for the same kind of crash. In this video, I'm going to break down my response, how to protect yourself, and have I started buying real estate again? Where am I buying? Or better yet, what am I buying? Let's talk about all of that in this video. Keep in mind the car is on self-driving mode and I am hands-free recording this as I've got a little dash magnet over here. So let's get into the video as I head on over to the airport. So number one, the most important thing to consider when you're buying real estate in any market, it doesn't matter what market you're in, is you have to have a Warren Buffett style margin of safety. That is beautiful. I'll give you an example. If you can buy a $500,000 home in a $700,000 neighborhood and that house takes $50K to fix up, now you're into the deal for about $550, maybe with closing costs and holding costs, call it $560. So you're into the deal for $560 in a $700,000 neighborhood, gives you a $140,000 buffer, or wedge we like to call it. That off of $700,000 is a 20% buffer. Real estate prices would have to decline 20%. And guess what? You would then be at a break even. You wouldn't even be in a position where you needed to sell. Imagine if somebody told you you could buy Tesla stock at $160 when it was actually trading for $200. That would be a similar 20% wedge. And I'm not talking options here. I'm legit saying day one, something's wrong in the market where you can buy the stock for 20% less than it's worth. The reason you can do that in real estate is because the home buyers who are buying today are not buying properties they can't move into. These are hoarder homes, which are exactly the kinds of homes that I'm looking at. They're moldy homes, they're massive fixer-uppers. They're basically properties that can't be on the market. They need that 50 grand. Now, we don't want to get into something you have to rebuild because then you're becoming a developer, right? That's a different world. We're talking about how can you fix an issue? Like maybe you had a swamp cooler that leaked through the roof, through the attic, through the floors, and down into the basement. And you can solve the water damage while repairing the cosmetics for $50,000. Well, that's the kind of work that a home buyer is not going to be interested in doing. However, you, as somebody who's looking to build your wealth, might say, you know what, I might be able to find a way to borrow from friends or family on a second. I've got money saved up for that kind of fix up. I'm willing to put that effort in. I want to buy that home for $5, compete against the multiple offers, which remember, anytime there are multiple offers, it's not a red flag of competition. It's actually a green flag of desirability. If you're writing an offer on a deal that you think is a good deal and there are no other offers, guess what? It's probably not a good deal. Of course, if you can get deals off market, that's great. People send me off market deals all the time because they want to work with us. They know we're a no hassle buyer and we're actually going to close our deals. If we say we're going to close a cash deal in 5 days, guess what? We close a cash deal in 5 days. They get paid, they have a no hassle buyer, and they have a relationship with us so we can keep doing deals. I'm getting deals sent to me all the time. California, Nevada, Arizona, Salt Lake, Oregon. People are sending us deals all over the place all the time. Starting with those close to us, though we're also very interested in areas in Florida and Texas, Idaho to some extent. But what's important is you gotta have this wedge. And you can arbitrage the market now because people are so fearful of doing work. The opportunity to get good deals and create a massive buffer is insane. Let me give you some scale to this, especially since my startup, House Hack, plans to do exactly this at scale. If we can get our hands on 100 of these style fixer-uppers that nobody can rent, nobody can live in, nobody can buy, and we can fix up 100 of them with $50 million, about 500K in on each deal, then that gives us about $10 million in gross profit on actually doing these deals after all the fix up is said and done for the properties. 100K wedge times 100 properties is $10 million. Of course, this is fantastic. $10 million return year one on $50 million would be phenomenal. I'm not making any promises, obviously, but those are some of the goals that we have and the opportunities that we see. So the goal is, how can you get your hands on wedge deals? And here's the trick, folks. After you identify wedges and you know what you're looking for, the next rule of thumb is you have to be fast. Wedge deals come on the market at 11 o'clock and they're sold by 2 o'clock. I know, because guess what? I've been saying for over a year now that we will start buying in Q3 or Q4 2023. And that's exactly what we've done with this formula. The deal came up at 11 o'clock. We had a cash offer in within a couple hours, and we had the deal signed by 2 o'clock. Within the next day, there were 8 other offers way higher than ours, but they went with us because we're easy to work with, and we wrote fast. We gave them a 1-day due diligence period, and they thought, hey, let the other offers come in while Kevin does his 1-day due diligence. Oh, look, Kevin wants to buy it. We even got a little bit more off, and great. Now we're done. Easy deal. Let's do more. So why, though, buy when the market is uncertain? Like, oh, are things going to crash again? What about all this unaffordability? It's not unaffordable if you're able to buy in cash. Obviously, if you're financing, it is unaffordable right now. Now, is that going to lead to the subprime disaster that we've previously seen? My belief is that most of the pain that real estate has seen so far, short of some kind of surge in inventory, is behind us. Over the last year, we've had pain in real estate prices because rates have exploded. Rates have exploded. That has led to some markets, especially in Arizona and Idaho, correcting about 20%. They've since bottomed out and come back about 10-ish%, but some of these markets are still down 10%, creating a potential buy the dip opportunity. The danger, though, obviously, is that inventory rises again, that we have some kind of surge in inventory. However, if we look at history, usually real estate surges in inventory do not end up driving a crash. What drives a crash is a surge in foreclosures and short sales, distressed sales. That's not what I'm expecting we're going to be facing at all, especially since we could probably lose about 20 to 30% equity in the market. The market could drop 20 or 30%, and you're still only going to be sitting somewhere around 8% of people underwater. That's insanely low. And not all of those people are going to sell just because all of a sudden they owe a little bit more than the property is worth. They could also resort to renting out the property. However, I do believe that a lot of vacation rentals and rentals that are no longer profitable are going to start testing the market. However, these are generally investors who are just facing less cash flow rather than all of a sudden urgent needs to dump their properties like what we saw in 2008. This is what I've been experiencing for about the last year as we've been making sure that inflation is gone, which basically is trending gone. Sure, we could get a little bit of a bumpy ride coming down. Come on, Mr. Max, you want to just hang out here for a sec while I finish the video? I'll leave the AC on for you. We can be in a situation where, people decide, look, I'm not going to do long-term or a short-term rental anymore. What do? They jump on over to short-term rental. Or long-term rental, rather. You go from short to long, right? Point is, there are ways that even investors who own right now, who need to transition, don't have to sell in distressed manners. If we were going to see any level of distress, it would have most likely been in December of 2022. And even then, we didn't see distress. That's when prices were slightly lower than where they are now. No distress then, not expecting massive distress going forward. However, even if distress comes, that wedge insulates us. So if we're down 10% in many markets that we're looking at now, and we get another 20% on top of that, we, in my opinion, have up to a 30% correction to protect us. That means the downside is really insulated. And even then, we wouldn't have to sell because we're buying cash. In my opinion, though, the upside is a lot greater, that we can buy these wedge deals and likely spend the next 2 or 3 years buying these properties nobody wants to renovate. As soon as rates come down, in the long term, 2 or 3 years, expect the valuation of these properties to really adjust. Now I know, to the upside, no guarantees. Now I know a lot of people say, Max, I got like 30 more seconds, all right? Now I know a lot of people say, oh, but Kevin, when rates come down, we're going to see these properties, everybody's gonna throw more inventory on the market, and we could see some pain again. And eventually we have to correct back to these prices that we saw in pre-COVID, right? Because before COVID, maybe you had a $650,000 house, that's an $800,000 house now. And the reality is, while that could happen, it doesn't need to. We don't need to undo the inflation that we've had. What we do need to do is wash the car. But the cool thing is, we got a new plate on this. Actually, I think I'm gonna pay to have them wash it here. Look at that, $69 for PP. But anyway, so if you look at an $800,000 house today, that was selling for about $650 previously. That represents about 18% inflation, which is roughly what we had. If you look at CPI from Feb-ish 2020 to now, that's roughly the inflation that we've had, is about 18%. So, point of all of that being said, we are in a position where we believe the actual facts, the actual data we're facing right now does not portend some kind of massive crash ahead. Any increase in inventory will actually be welcomed for us over the next 2 years to buy as many of these fixer-uppers as we can and actually bring that supply to market, which helps people who need to rent or in the future potentially need to buy. So we're really excited. If you want to learn more for when we're ready to start fundraising for HouseHack, go to househack.com. Otherwise, these are my thoughts on the upcoming real estate market crash that everybody's worried about. I think actually that fear is exactly when I want to be buying, because everybody else is so fearful about real estate that's the time that I really want to be buying. I like buying when people are fearful, and then you have to be greedy when everybody is fearful. That's the Warren Buffett quote, right? Be greedy when people are fearful. Whereas when everybody's being greedy, that's the time to consider selling. And so I think now is that time for real estate, to buy when everybody else is fearful. My take. Thanks so much for watching. I'll keep you updated on how things go. It is true, we are closing on our first HouseHack deal, and it's, in my opinion, an over $100,000 wedge that I got against 8 offers. It's the first offer we wrote, instantly got it. It was fantastic. Stay tuned. There'll be a lot more deals and a lot more coverage. Thanks. Bye.